How can a company make $100,000 profit and still go bankrupt?
Huh?
The answer will change how you run your business. Have you ever heard this story? A company shows great profit on paper, but suddenly goes bankrupt. It sounds impossible. It sounds wrong, but it happens every single day. Hello, I'm Danny A from Accounting 123. Today we will talk about the difference between profit and cash flow, the most dangerous confusion in business. Let's see this. The company was profitable, strong earnings, healthy margins, positive net income, but it went bankrupt, ran out of cash, couldn't pay bills, forced to close. The contradiction that destroys businesses. If the company is profitable, shouldn't it have money? The question that reveals the gap in understanding. And the answer is not necessarily. And this is one of the most dangerous confusion in business. Profit and cash aren't the same thing. Understanding the difference can save your business. Today in Accounting 123, we'll cover the following. What is profit? The accounting measure of business performance. What is cash flow? The movement of actual money in and out. Why the difference matters. How misunderstanding this kills businesses. And we will explain this in the simplest possible way. Part 1. Profit. Understanding what profit really means. What is profit? Profit is what remains after subtracting expenses from revenue. Is the fundamental measure of whether your business is earning money, also called net income or the bottom line, because it appears at the bottom of your income statement. When someone says, we made 50,000 profit, this is what they mean. Revenue minus expenses, this is the profit. First, revenue. Money earned from sales and services minus expenses paid for operation equals profit remaining. The most fundamental equation in business accounting. A simple example. $10,000 revenue, money coming in from sales. $8,000 expenses, costs to run the business. The result is $2,000 profit. What's left after expenses? Sounds simple, right? That's the profit calculation on paper. But here is where it gets tricky. Here is the catch. Profit is an accounting concept. It doesn't necessarily mean cash in the bank. Accounting profit tells you how your business performed over time, but it doesn't show what's actually in your account today. This is the single biggest confusion for small business owners. Part 2. Cash flow. What is cash flow? Cash flow is the money that actually enters or leaves your bank account. It's real money moving in real time. Think of it as the heartbeat of your business. Without steady cash flow, even profitable businesses can collapse. Cash inflow. Money coming into your bank account. This can be customer payments, money received from clients today, or loan received, cash from borrowing or financing, or maybe investment deposited, capital injected into the business. Cash outflow, money leaving your bank account. This could be rent paid, monthly vacation costs, salaries paid, employee wages and benefits, supplier invoices, payments to vendors, utilities paid, electricity, internet, phone, etc. Cash flow versus accounting. The accounting profit is calculated on paper, based on revenue recognition, and includes non-cash items. It shows performance over time. Cash flow, however, is the real money moving, tracks actual bank transactions, and shows what's in the account now. Cash flow reveals your liquidity today. Cash flow tracks reality, not calculations. Part 3. The dangerous confusion. The most common and costly mistake small business owners make. Most business owners make this mistake. They see profit on the accounting report and assume the money is in the bank. Then they go to pay their suppliers and the account is at zero. If you ever thought we had a great month while stressing about tomorrow's bills, this is exactly for you. Profit on paper doesn't equal cash in your account every single time. The big mistake. Many businesses think profit is the same thing as cash. This is not true. Let's take a quick quiz. Think before the next slide. So, we have the following scenario. You sell $100,000 in products today. Your customer has 90-day payment terms, but your suppliers want payment tomorrow. Do you have money to pay them? Yes or no? Answer before scrolling. The answer reveals the single most dangerous gap in business finance. And the answer is no. Here is why. You have sold goods for $100,000. That's profit on paper. But the money comes in after 90 days. On the other side, the suppliers want payment tomorrow. Result, you have $100,000 in profit in the report and zero in the bank account. This is a cash flow problem. And that's exactly what kills businesses. Why it matters? You can go bankrupt even when your business is profitable. Let's see the example. The sale, $100,000. You sell $100,000 in products. Great business, right? Your products are flying off the shelves. Customers love what you're selling and the numbers look amazing on paper. The problem, payment terms. But your customers pay in 90 days. You won't see that $100,000 for 3 months. That's the catch. Your customers love your products, but they have negotiated 90-day payment terms. What feels like a win today becomes a cash flow challenge tomorrow. The obligations. Meanwhile, you must pay today suppliers, raw materials and inventory costs due now, salaries. Your team expects paychecks every 2 weeks, rent, office or warehouse space costs every month, utilities, electricity, internet and other essential services. These bills don't wait, they come due every single day, regardless of when your customers pay you. The contradiction. In the accounting report, you see profit $100,000. Looks great on paper, but in your bank account, you have zero balance. Can't pay bills today with this zero balance. Accounting profit doesn't equal actual cash in the bank. This gap between what you have sold and what you can actually spend is where businesses fail. Let's name the problem. This is called a cash flow problem. And it destroys many businesses, even profitable ones. You can be making money on paper while running out of actual cash to operate. Why businesses fail? Most businesses don't fail because of bad products. They fail because they run out of cash. Even profitable companies collapse when they can't pay their bills on time. The product doesn't matter if you don't have the cash to keep the doors open. Who watches cash flow? This is why the experts always look at cash flow. Banks. Before lending you money, they want to see you can actually pay it back. Investors. Before investing their capital, they need proof you won't run out of cash. Managers. Before making decisions, they need to know what cash is actually available. Remember this golden rule. Profit shows performance, how well you're doing over time, but cash flow shows survival, whether you can operate today. A healthy business needs both. Think of profit as your speedometer and cash flow as your fuel gauge. You need both to keep thriving. How to use this tomorrow morning. Open your bank statement and your profit and loss report side by side. Step 2. If the numbers are significantly different, you have a cash flow gap. Step 3. Find out why. Are customers paying late? Paying suppliers too early? That gap is where businesses quietly die. Do this every week. 10 minutes. It could save your business. The final takeaway. Profit is important, but cash is king. Next time a company reports millions in profit, ask, how much cash do they actually have? Because profit tells you how well they did. Cash tells you whether they will survive. I'm Danny A from Accounting 123. Accounting explained for real people. If you want, you can download the cheat sheet in the description below. Subscribe for the next lesson. Assets versus expenses. The most misunderstood concept in accounting.